So right now, the most powerful tech giants on Earth, we're talking companies worth trillions of dollars
Right.
with practically unlimited resources. They are all standing in line, essentially holding blank checks.
Yep, just waiting.
Exactly. Waiting on a single piece of hardware from one single company. Today, we have a really focused mission for you. We are pulling apart this short but honestly incredibly dense financial excerpt about the undisputed titan of the AI era,
Nvidia.
Nvidia. We're going to unpack the staggering mechanics behind their rise, why the entire global tech ecosystem is currently, hanging on their every shipment. And then,
And this is the crazy part.
right, we have to analyze this massive cliffhanger.
Yeah.
The text leaves us with this jarring warning about a hidden risk tied to the company's past that supposedly nobody is talking about.
It really is a narrative of extreme contrast. I mean, you have this unprecedented historic high, and then boom,
Boom.
a very sudden, very dark shadow gets cast right at the end of the analysis.
Okay, let's unpack this. Whether you are a seasoned tech investor managing a huge portfolio or, you're just trying to wrap your head around the actual mechanics behind this whole AI craze dominating the news.
Which is everywhere.
It's everywhere. This deep dive will break down the engine of the boom without overwhelming you. And we're starting with some numbers that, well, they just completely break traditional financial models.
They really do.
We are looking at a stock that has soared 1,300% over the past 5 years.
1,300.
Yeah, let that sink in. But more importantly, we're looking at the underlying revenue. In the latest full year, revenue climbed 65% to a record $215 billion.
Eye-popping. Truly eye-popping.
And the engine driving every single penny of that is the AI chip, specifically Nvidia's graphics processing units, or GPUs.
Right, because when you look at the architecture of the current AI boom, Nvidia's GPU is the foundational layer. The excerpt we're analyzing today anchors on this exact idea. It explicitly calls their chips the key product necessary for AI to take shape, but it also makes a really crucial distinction that we shouldn't gloss over.
Which is?
The market isn't a literal monopoly in terms of mere existence. Like, competitors do exist.
Right.
Other companies absolutely manufacture AI chips.
Yeah, the text explicitly notes there are other options out there, but it emphasizes that NVIDIA's GPUs have proven to be the, quote, fastest.
The fastest, yeah.
And that single word fastest seems to be the entire thesis for why these tech giants are handing over all their capital.
Yeah.
But if to push back a little here,
Correct.
wait, processing speed alone cannot possibly be a long-term moat?
Right.
You'd think so. I mean, someone else can just build a faster chip eventually.
Yeah.
Why hasn't a rival like Google or Microsoft, who have infinite money?
Literally
Right. Why haven't they just outspent them on R&D to build a faster chip? Can a $215 billion empire truly be built just because your clock speed is a tiny bit higher than the other guys?
Well, what's fascinating here is that we have to redefine what fastest actually means in the context of artificial intelligence.
Okay.
Because in consumer electronics, a faster chip just means your apps open a fraction of a second sooner.
Right. It's nice to have.
Exactly. It's
Yeah.
a luxury. But in AI development, speed is not a luxury. It is the absolute foundational requirement of the underlying math.
How so?
Well, training a large language model requires processing unimaginable, like mountain-sized data sets. We are talking about trillions of parameters.
So it's totally a matter of scale. How does that translate to the actual physical hardware, though?
Let's use an analogy. Think about traditional computing, like the CPU that runs your laptop.
Okay.
It operates like a single brilliant mathematician. You give that mathematician a highly complex calculus problem, and they will solve it sequentially, step by step, very efficiently.
Makes sense.
But AI doesn't need sequential calculus. AI requires millions of incredibly basic arithmetic problems to be solved at the exact same millisecond.
Oh, wow.
So instead of one brilliant mathematician, NVIDIA's GPUs act like a stadium filled with 100,000 middle schoolers.
A stadium of middle schoolers.
Yes, none of them are doing complex calculus, but they are solving millions of basic math problems simultaneously. That parallel processing is the mechanism of the speed.
Oh, that makes perfect sense. So they're just perfectly engineered for the specific brute force math that AI requires.
Exactly.
But even so, going back to my pushback, if another company builds a stadium with, say, 110,000 middle schoolers. Doesn't Nvidia just lose their crown?
In theory, yes. But here's where the causality of that speed actually dictates the market reality. In AI, if a model takes 6 months to train on a competitor's chip,
Right.
but only 1 month on Nvidia's architecture, that is 5 months of lost time to market.
And time is everything.
In the tech sector right now, a 5-month delay is a literal death sentence for a product. If you release your AI model 5 months after your competitor releases theirs, the market has already moved on.
You're completely forgotten.
You've lost the user base. You've lost the narrative. The tech giants are not just buying hardware. They are buying the speed to ensure they aren't rendered obsolete.
Ah, I see. They're quite literally buying time.
Yes.
So in this high-stakes space race, coming in second means you might as well not have launched the rocket at all.
Precisely.
The speed isn't just a feature on a spec sheet. It is the difference between leading the global market or missing the revolution entirely.
And that absolute desperation for time is what forces these multi-trillion-dollar corporations to be entirely bottlenecked by a single component.
It's wild.
It is incredibly rare in the history of business for a single product attribute, just speed, to dictate the trajectory of an entire global industry. Usually, companies compete on price.
Right, or ecosystem integration.
Or enterprise support, yeah. But here, price is almost irrelevant. The tech giants are writing blank checks because they physically cannot afford the time penalty of using a slower GPU.
Which perfectly bridges us into how that intense demand actually translates into the math we mentioned earlier.
That eye-popping math.
Yeah. We've established the why. Tech giants are held hostage by the need for speed. Now let's look at the what. A 1,300% gain in the stock over 5 years, and that latest full-year revenue hitting $215 billion.
Massive.
But here's where it gets really interesting. It's the 65% jump in a single year that completely breaks the paradigm for me.
It completely defies traditional corporate gravity.
Completely. I mean, we are used to seeing hypergrowth in seed stage startups, right?
Sure, yeah.
A new app launches, it goes viral, and their revenue jumps 100% because they went from like $1 million to $2 million.
Easy to double a small number.
Exactly.
Yeah.
But seeing a mature, large cap hardware company suddenly post a 65% year-over-year revenue growth to hit $215 billion, that completely breaks traditional valuation models.
It really does.
To add 65% at that scale means you are manifesting tens of billions of dollars in net new revenue in just a 12-month window.
And we have to separate this from the software world to truly appreciate how anomalous this is.
That's a great point.
In software, if you want to grow 65%, you just scale your cloud servers and sell more licenses. The marginal cost of distributing software is practically zero.
You just copy and paste the code.
Right. But Nvidia is a hardware company.
Yeah.
Growing hardware revenue by 65% at the $100 billion scale requires physical atoms.
Yeah, actual stuff.
It requires coordinating global supply chains, securing rare earth metals, booking literal cargo planes, and running fabrication plants around the clock. The logistics of physically producing and shipping enough silicon to realize a $215 billion revenue line is just staggering.
The checks are actually clearing, and the physical boxes are actually shipping.
Yes.
Which is huge because, often when we see stocks explode 1,300% over a few years, it's pure speculation.
Oh, absolutely.
We saw it in the dot-com bubble. We saw it in various crypto cycles. It's usually hype built on promises of future earnings that just do not exist yet.
Vaping. Vaporware.
Right. But this excerpt anchors the narrative to a physical, tangible reality. The tech giants are actually buying that many GPUs.
The author describes this as a very bright story, and it is vital to understand why it's so bright. This kind of exponential growth fundamentally changes how a company operates within the broader economy.
How so?
Well, Nvidia isn't just participating in the tech sector anymore. They are effectively shaping macroeconomic flows. If you look at the capital expenditure budgets, the capex of companies like Meta, Microsoft, and Amazon.
The big guys.
Right. A massive percentage of those billions is flowing directly into Nvidia's accounts. Nvidia is effectively vacuuming up the research and development budgets of their own biggest clients.
Wow. It is the ultimate bright story. I mean, they possess the one thing everyone needs. They have the absolute biggest clients on Earth held captive by a time-to-market bottleneck.
Yep.
They have a 1,300% stock gain, and they are shattering revenue records with physical hardware. You read the first half of this analysis, and you think, man, this is unstoppable. This is the perfect business.
But then,
But then, the text executes a massive narrative pivot.
A very sharp, deliberate pivot that changes the entire complexion of the analysis.
Yeah, we go from this blindingly bright story of record revenues, and abruptly, the text introduces a dark cloud, a sudden shift that demands close attention.
It really catches you off guard.
It does. The excerpt states, and I quote, "Amid this very bright story, though, lies a risk to Nvidia stock that nobody is talking about."
Chilling.
And then, immediately following that warning, we get an intriguing, almost cryptic subheading. It just says, Nvidia's early days.
And that is exactly where our source material cuts off.
It is a remarkable piece of financial cliffhanging.
It plays directly on the anxiety of the massive numbers we just discussed.
It really does. And look, I have a major issue I need to raise here.
Let's hear it.
How can a company generating $215 billion, a company that is scrutinized by literally thousands of Wall Street analysts every single morning, have a massive risk that nobody is talking about?
It sounds impossible.
Right. In today's hyper-connected financial media landscape, where every single supply chain rumor is tracked by satellites, how is a secret risk even possible? The text actually mentions an image right at this point. It says, an investor looks pensively at something on a laptop.
Yeah, I remember that.
And the irony is palpable, because that is exactly the feeling this excerpt forces onto you. You are left staring at the screen, just wondering where the hidden trapdoor is.
Well, if we connect this to the bigger picture, we have to isolate that specific phrase the author chose, Nvidia's early days. While the text cuts off before spelling out the exact granular nature of the risk, we can deduce a lot by analyzing why an analyst would look backward to a company's origins to find a modern vulnerability in a $2 trillion giant.
So what does this all mean? I mean, why look backward when the company is literally building the architecture of the future?
Because the foundations of a company often dictate its structural limitations, regardless of how much capital you pour on top of it later.
Oh, I see.
Think about what a 1,300% stock surge and a 65% revenue jump actually does to a corporate entity. It means the company has expanded at a violently rapid, almost unnatural pace.
Yeah, scaling that fast breaks things.
Exactly. It has grown exponentially past its original form. When a company scales that quickly, the foundational dependencies that were established in its early days are put under unimaginable stress.
Or you're talking about like technical debt, like old code that just hasn't been updated?
Technical debt is part of it, but in the hardware world, it is more often physical and operational debt. Let's look at what the early days of Nvidia actually looked like. Decades ago, they were primarily a gaming hardware company. They built graphics cards for video game consoles and PCs.
Right, for gamers.
Exactly. And to survive as a scrappy hardware company, you make certain strategic partnerships. For instance, Nvidia designs their chips, but they do not physically manufacture the silicon themselves.
Oh, really?
No, they outsource the actual baking of the chips to third-party fabrication plants, primarily in Taiwan.
Okay, the picture's getting a lot clearer now.
In their early days, relying on a single major partner to manufacture your chips made perfect financial sense. You didn't have the capital to build your own multi-billion-dollar foundry.
Right, why build a factory if you don't have to?
Exactly. But fast forward to today, you are now the single bottleneck for the entire global AI revolution. You are generating $215 billion a year. And yet you are still relying on a supply chain architecture and vendor relationships established when you were a fraction of your current size.
It's like inheriting a quaint two-story house. And instead of pouring a new concrete foundation, you just decide to build a 100-story mega skyscraper right on top of the old basement.
That is a perfect analogy.
The upper floors are state-of-the-art, the penthouse is breaking revenue records, but the concrete in the ground was never designed to hold that much weight.
That captures the structural mechanics perfectly. The author is suggesting that there is a foundational element, whether it is an over-reliance on a specific manufacturing hub, a legacy architecture flaw, or a fragile supply chain dependency, that just has not been modernized to match the $215 billion scale.
But wait, why is nobody talking about it then?
That is due to a very specific psychological phenomenon in the markets.
Momentum blindness.
Precisely. When a stock is up 1,300%, human psychology dictates that the market focuses exclusively on the momentum.
Everyone's just looking at the green arrows.
Right. Analysts are incentivized to project the next quarter's growth, not dig into the original foundation. Nobody wants to be the one analyst shouting about structural risks and supply chain fragility when everyone else in the room is making money hand over fist.
Don't ruin the party.
Exactly. Hence, it becomes a risk that, quite literally, nobody is talking about.
Because to acknowledge the risk is to threaten the $215 billion party.
Yeah.
But ignoring a structural risk rooted in a company's early DNA does not make the stress go away. It just means that when the foundation finally does fracture under the weight of all those new floors, nobody inside the skyscraper is prepared for the collapse.
And in the context of hardware, a fracture is catastrophic.
Right, because it's physical.
Exactly. If a software company has a bug, they push a patch over the internet in an hour. If a hardware company faces a supply chain fracture or a silicon defect rooted in their legacy systems, it takes months or years to retool fabrication plants.
Oh, wow.
That 5-month delay we talked about earlier.
The death sentence.
The one that is a death sentence for their clients. It works both ways. If Nvidia's foundation cracks, the entire AI industry loses time.
Which brings a completely different weight to this whole deep dive. We set out today to understand the mechanics of the boom, and we've uncovered a really fascinating duality here.
We really have.
Let's recap the journey we just took. We started by exploring the physical bottleneck of the AI revolution. We looked at how a single attribute, speed, became the ultimate currency for tech giants.
Speed is everything.
Right, because AI development requires processing oceans of data simultaneously. Nvidia's parallel processing architecture became the only viable option for companies desperate to beat their rivals to market.
And that time-to-market desperation is what fueled the unprecedented financials. It transformed Nvidia from a successful hardware provider into an economic black hole, vacuuming up the capital expenditure of the world's largest tech firms.
Resulting in a 1,300% stock surge and $215 billion in revenue.
Which is, by all traditional metrics, a blindingly bright story.
But as we just broke down, that bright light masks a critical vulnerability, a massive structural risk tied not to the futuristic promises of artificial intelligence, but to the limitations of the company's own past, its early days.
The faster a company runs into the future, the more aggressively its past tries to pull it backward.
Well said. So, for you, listening to this right now, let this be a lens through which you view the entire tech landscape. When you see those massive paradigm-shifting numbers dominating the financial headlines, and you see companies seemingly defying economic gravity.
Remember to look down.
Exactly. Remember to look past the penthouse. Always look for the hidden narratives buried in the foundation. Even in the most universally successful, heavily scrutinized companies on the planet, the brightest lights always cast the darkest shadows.
And this raises a really important question for you to take away today.
Leave us with it.
We have established that the entire modern AI revolution, all the advancements, all the multi-trillion-dollar tech giants, all the global momentum, is entirely bottlenecked by this single company's hardware.
Yeah.
If Nvidia is truly harboring a massive, unresolved structural risk rooted in its early days, what happens to the global AI skyline if that unspoken risk suddenly becomes the only thing everyone is talking about?
Wow. It really makes you reconsider the concept of a bottleneck. I mean, it is one thing to control the only bridge into the future. It is another thing entirely if that bridge was built on a foundation that was never meant to hold the weight of the whole world.